Working man investor, today's video, are we headed towards a stagflation environment? And if so, what can you do to protect yourself financially? Stagflation is a combination of higher inflation, low economic growth, and higher unemployment. This is the worst case scenario for the Federal Reserve because they don't have the tools in their toolbox to fight everything at once. They have to pick one. So if they fight inflation, what they can do is they raise interest rate, but higher interest rates often lead to higher unemployment rates and less economic growth. This is because high interest rates reduce the overall economic activity by making businesses less willing to hire and expand. This happens because higher interest rates increase borrowing costs. Remember, an interest rate is nothing more than the cost of money. So when higher interest rates increase the cost for businesses and consumers, this leads to decreased spending and less investment. Consequently, businesses often will cut back on production and jobs to match the reduced demand. The higher unemployment leads to even less spending overall and brings down the prices of everything. However, this leads to a recession. So the Federal Reserve is in a difficult situation. They can either raise interest rates up, break the back of inflation, but then in turn that causes a recession and unemployment to go even higher and economic growth to get even lower. The other thing that they can do, which is unlikely, they can choose to lower interest rates to fight the unemployment and the low growth in the economy. However, this will encourage businesses and people to take out loans and go spend because one person's spending is just another person's income. While this will increase employment and spending throughout the economy, it's going to shoot inflation through the roof. And anything you've got sitting in a savings account is going to be just eaten away. It's going to lose buying power. So fortunately, the United States has only had to deal with stagflation once in the 70s and the early 80s. This was caused by the Oil Embargo Act in the 80s. Today, the United States doesn't have to worry about an oil embargo. This is because it is now one of the world's leaders in oil production, and we're no longer at the mercy of foreign oil. However, we are facing uncertainty through our economy around tariffs. Are a tax businesses must pay to import their products into the United States to sell to us. This tax is often passed on to us, the consumers, in the form of higher prices. This uncertainty around these on-again, off-again tariffs are causing businesses to cut spending and slow their investment. The combination of slow growth and higher prices from the tariffs has many concerned that we might be returning to this stagflation environment. Now, President Trump's tariff policy, while it has increased the risk of higher inflation and lower growth, there is a chance that these businesses do not pass all of these tariff costs onto the consumer, and they just eat it. They just take a loss of it, although many have said they won't. However, even if they do not pass it on to the consumer, it's still going to affect their bottom line. This is an extra expense. So the company still has to be profitable. So what is one of the things they're going to do if they're not going to either not pass the tariff costs onto us, the consumer, or not pass as much onto us? They're going to lay people off. They're going to cut back on shifts. They're going to possibly close businesses down in certain areas, and it will slow economic growth. So it's important to note that we're not currently in a stagflation environment. This is just a video telling you to watch for it. We're not currently in it, but the threat for stagflation is the highest it's been really since the 80s. Higher inflation and higher unemployment are going to make it difficult on families that budgets are already stretched out. So what are the steps that you can take to protect yourself if we do have a stagflation environment? First, I have to tell you my disclaimer. I am not a financial advisor. You can lose money investing, and you will lose money at some point. It is important that you do your own research and decide what is best for you and your family and not take the advice of somebody you found on YouTube. So, to protect yourself from stagflation, the first thing is to understand the history of stagflation. Understand how Paul Volcker in the 1980s broke inflation. So Volcker was the Fed chairman in the 1980s when Reagan appointed him and we were having serious inflation problems. Volcker dramatically tightened the monetary policy. He did this by raising interest rates rapidly and often. This shocked the market and crushed demand for loans. Lack of credit caused economic activity to drastically slow down. While this did break the back of the inflation, it also forced us into a deep recession. Now, it is of my opinion that this is the best course of action to take in a stagflation environment, and that's what the Federal Reserve is most likely to do. Ending inflation needs to be priority number one because we have so many people struggling right now that just can't afford prices to go up. So I think the Federal Reserve would bank on raising interest rates, breaking the back of inflation. It would put us into a deep recession. You could see a 6, 7, 8% unemployment rate. Sounds bad, but at least 92 to 93% of people are still working. Stabilize prices and not eat up everybody's savings. It would probably just be the worst of two evils. Now, the other option would be to fight growth and unemployment. I do not think the Fed will do this, but I'm including it in here as it's a possibility. This will encourage businesses to take out loans and invest into their business, meaning if they choose to lower interest rates. This will increase employment and wages, but it's also going to cause inflation to run really hot. Prices on everything are going to start going up. Again, this is highly unlikely, but it's something I wanted to include in this video as it's an option because they only have two options and you can't do them both at the same time. You have to pick one. This is why it makes it so difficult on the Feds and why I said they don't have tools in the toolbox to fight both at the same time. They have to choose one. Either they're going to cut interest rates and run inflation one wild and everything we need in life to go up in price, or they're going to jack interest rates up, break the back of inflation, probably force us into a recession, put people out of work, but at least balance the prices of everything and not eat away at everybody's savings. So what do you do in these situations to protect yourself? In either one of these situations, again, this is not financial advice. Remember the disclaimer I read earlier. Do not take the advice of a random person on YouTube. So you want to start by preparing for the most likely of the two scenarios. The most likely of the two scenarios is that they're going to raise interest rates and cause a recession. So when the Fed raises interest rates, it causes the interest rates on credit cards to go up. Credit card interest rates are highly attached to the Fed fund rates. When the Federal Reserve raises rates, all they're raising is the Fed fund rates, which is the rate that banks charge one another for overnight loans to meet reserve requirements. But it affects other things. So when they raise the interest rate, credit card interest rates often follow suit relatively quickly. Therefore, if you have any credit card debt, you need to start paying that down now. Think of it this way. This is the best investment you can make in yourself. If you have a credit card that's charging you 8% interest a year, by paying off that credit card, you've got an 18% return on your money because you're no longer having to pay that interest. It's more money in your pocket to then go out and invest in assets. So that would be my first thing I would do. The next thing I would do is while you're doing that, you want to try to build up at least a 6-month emergency fund because remember, as the interest rates start to tick up and they're trying to break the back of inflation, we're going to go into a recession and you could lose your job. You'd like to be credit card debt free and you'd like to have an emergency fund in place so you can at least keep a roof over your head and keep yourself fed while you look for another job and wait for the economy to heal itself. Now, in the highly unlikely case that the Federal Reserve decides to fight stagflation by cutting rates and focusing on more growth and more employment, what you need to understand that is asset prices are going to run higher. By asset prices, real estate, stocks, commodities. This is because the new money at the low rates is going to be available to people that understand how money works. They're going to take this cheap debt with low interest rates and use it to buy assets that make more money than the debt. So say interest rates are 2% for a loan. They take out a loan and they're buying like an asset that's going to produce a cash flow like a rental property that more than covers that debt at the end, that mortgage at the end of the month and puts money in their pocket. That's what they're going to do. And as they're doing that, it's a supply and demand. The asset prices start to raise as you get all this new money coming into the system chasing these assets. The asset prices start to go up and you're going to get a wealth gap between the rich and the poor. continuing to grow. This is the Cantillon effect. It's one of the economic forces that I study. If you subscribe to my channel, I actually have a playlist where I explain the Cantillon effect. But this is another example of the Cantillon effect. When new money comes into the system, those closest to the new money that have access to it take that money and they buy assets. The assets then inflate in price, and the wealth gap between the rich and the poor get larger. So you want to buy assets. Now, a lot of you aren't going to be able to buy real estate. I understand that. So what you can also look into doing is commodities, gold or silver. Now, at the making of this video, gold is $3,400 an ounce. So a lot of you may not be able to afford that either. That's fine. Silver is only selling for $32 an ounce. Almost everybody has 32 bucks. You can go out and buy yourself some silver, some actual physical silver from a coin shop, and hang on to that. You could also buy stocks. You could buy stocks in a gold mining company. Okay, because that'll go up. You can look for a gold ETF. I love ETFs. I talk about ETFs a lot, exchange traded funds. They'll mimic the price of gold. It trades just like a stock. You can do that too. And you can also buy cryptocurrency. The thing about cryptocurrency is understand it's much more volatile than gold and silver. And it's only been around for about 20 years. It doesn't have the history of a hedge against inflation that gold and silver does. You pick up the Bible and read through the Bible, they talk about gold and silver coins being used as money back then. That's how long gold and silver has been viewed by mankind as money, basically since we started to invent money. Therefore, I recommend gold and silver over cryptocurrency, but if you want to do cryptocurrency, that's fine too. So those are some of the steps you can do to protect yourself in either one of these situations. Again, I want to just repeat, we're not in a stagflation environment right now, and I think the chances of us going to a stagflation environment are still unlikely, but it's good to understand that it's a threat and why it's a threat and how it was broken in the 1980s when we did go through it, and understanding what causes asset prices to go up and how you can invest in it in case this happens. So you want to know what the Federal Reserve is going to do in the unlikely case that the Fed does decide to fight low economic growth and lower interest rates. Move into an asset class that you can afford and that you're comfortable with, even if you buy just a little bit of it. I'm not saying go out and spend $30,000 on silver coins. Don't do that. Just a good idea to have some of it to protect you. And then go back and study the 1980s, the Embargo Act, and stagflation. Give yourself a little history lesson on it, and that'll help prepare you for if we do have a stagflationary environment. So that's what I got for you today. Working Man Investor. Keep grinding, people.